Okay, so the last time we looked into the return on equity stuff, right? Um, I have to show you one more thing. Let me go to. Okay, so here, okay, this is the good example on return on equity, because what does it do that why you pay high premium for company that consistently making high return on equity. So there are the two companies. There is a company A and company B. The company has a book value 10 million. Company B has a 20 million. Both are earning the same amount, 4 million, 4 million. So return on equity for the company A is 40%, whereas return on equity for company B is 20%. Now, since they both are making same amount of money, the owner wants to sell his business and wants asking for the price 32 million, which is 8 times of the net profit. Because the 4 million is the net profit, so if you multiply by 8, it's 32 million. So in case scenario A, company A, you are paying 22 million more because owner is asking 32 million, 10 million is book value, so you are paying 22 million more. Whereas in the company B, you are paying 12 million more. Now, the question is how much will you pay for both companies? Would you go with 32 million for both companies? Or would you pay a little bit more for company A and pay a little bit less for company B? Do you have any idea like what would you pay for this if these things?
Could you repeat that?
Okay, so what I'm saying that my question is that the owner is asking you 32 million for company A and the 32 million for company B. Will you pay 32 million for company A and will you pay 32 million for company B, or you want to change the price? Okay, here is the thing. See, the company A, the return on equity is 40%. So even both are making same amount of net profit. You're not going to pay the same amount, 32 million for both companies. And here is the reason why. And these examples will prove that the company that produces high return on equity require price to book value high or require more premium than the company which is earning less on return on equity. So think about this. Let's say if you want to double the profit, this line, okay, for both companies. So I want to make now profit of 8 million here, 8 million here. So in order to double my profit, I have to double my book value, because You need a more machinery for the more output. 4 million you were able to produce 4 million using 10 million worth of asset. For the company A, you want to double the profit, you want to go to the 8 million, then definitely you have to invest more. And in company A, you have to invest 10 million more to produce 8 million of net profit. Now, if you look at the company B required 20 million to produce 4 million net profit. When you want to double that profit to 8 million, here you need a 20 million cash extra. So the new book value will be 40 million, here would be 20 million. So why this company, I would pay more for this company? Because if you see that to produce the same amount of net profit, I have to invest less cash in the system. So if owner asks me 32 million for this company, I will pay. But for this company, I would not pay 32 million. I would say probably I can pay 6 or 7 times or 5 times net earnings, so net profit. So instead of 4 million, I would probably try to convince him to sell it for 24 million, 6 times of net profit, or 28 million. But I would not pay 8 times, because the return on equity, this company is making 20%. So even in this case scenario, if you see 2 businesses are identical, but one requires less cash, producing the same amount of net profit, asking price is going to be different, because the cash infusion, if you want to double the inventory, if you want to double the production output, whatever you want to double to get your profit double, net profit double, you have to put more cash in. And that's why this example I want to show you at the last lesson, we didn't get the time. But this is the reason why the high return on equity is always going to ask you for the high multiples. So is this clear to you, Dave?
Yeah.
Oh, good. So here, this is the table. I'm not going to pay them. Here, whatever I explained you, it's here.
Yeah.
Right. So whenever you see a company that constantly produce high return on its net tangible asset or book value, don't hesitate to pay a little bit more to acquire the business or stock. And we will go into that. Okay. So this is about the return on equity. Now today, what we are going to learn is, last time we learned how to value the company using return on equity. You remember that example in the Word document we did for the book value of Coca-Cola, return on equity for last 10-year average.
Yeah.
So now there is another method where you can also find the company value. You can figure it out if you are paying too much or not. So let's go to that. So here I've been through this free cash flow. That it's a net cash provided by operating activity minus capital expenditure. Now, we've been through this exercise. Now, all investment, when I buy stock, what I do is I don't have to go in. I mean, I can figure it out in 5 minutes. How much amount do I want to pay? Because the okay, so there is a thing that has been set up, that price to earning ratio. Have you ever heard that term? Dave, have you ever heard the term price to earning ratio?
Yeah, I have.
Right? So what is the good price to earning ratio according to you?
According to me,
Yeah,
uh, like I don't know, below 20 or
yeah, that sounds good.
yeah.
Yeah, so the notion is right now that Warren Buffett also prefers, and everybody, most value investment, they prefer 15 times. Okay. The reason why they prefer 15 times, because that's what the market has produced. So if I tell you that market has on average produced, which is based on not individual company, but the whole index, which is S&P 500. So for the S&P 500, in the last 45 years, they have average produced 7% return. Okay. So anytime, if you divided price to earning ratio, um, like 100 divided by price to earning ratio will give you the number of percentage. Basically, when I said P ratio is 20, right? Do you
Yeah.
know how many percentage return are you getting? Like how much you are paying, how much return you are expecting. Consider that 20 times P ratio as a bond. So in a bond, what happens that you will keep getting 3%, 4%, predefined value. You've been getting that for the maturity of bond. The same thing with the stock. The only difference with the stock is that stock value increase because stock has a growth. Bond will not, bond value would not increase or decrease. It does when, let's say, the company says that they're not going to be able to pay to the preferred shareholder any dividend. Of course, yeah, then whatever preferred shareholder bond price $100 will drop down to $30 or $40 because, but what I'm saying in this case, if the PE ratio is 20, do you know what is your return on investment for that year? I'm asking you the questions. If the PE ratio is 20, okay. Okay, so let's do this. If you are investing $100, okay, and you are making $5, what is your return on investment? So for the 1 year, you are investing $100 and you are earning $5 for your investment of $100. What percentage return you think that would be? It's a simple, right? $100.
5%?
Yeah, 5%, right?
Yeah.
Now just think this other way. How many years would it take you to collect all $100?
20?
20, right? So
Yeah.
that is the P, 20. So when somebody says P 20, 15, what does that mean? If the company doesn't have any growth and it's going to make the same amount of money, you will recover all your money, whatever the years the P dictates. If the P is 40, that means it's going to take you 40 years to get your money back, right? Now, that's why people say that, okay, why you want to pay more fee? Why would I invest in the company that takes 40 years to recover my money? In this scenario, what we did is we didn't look on the other side where there was one factor that influenced the PE ratio, which is called growth. Okay. When we thought about 5 times, 20 times PE, $100 and $5, we assume that company is going to make $5 every single year. We did not assume that the company is growing 10%. If company is growing at 10%, then what's going to happen? That your return would be little bit earlier than the 15 years. Will you get that things clear? Let's say the companies, so in our example, you have $100, right?
Yeah.
And you are making $5 every year. Okay. How many years will it take? 20 years, right?
Yeah.
Just think about that now. That this company, the one it's making $5, it's growing at 10%. Okay. So what's going to happen that okay, so in the first year, which is 2022, earning was $5. Company is growing at 15%. Okay, sorry, 10%. So the next year, 2023, what do you think earning can be? What would be the earning?
Like 5.5.
Yeah, perfect. Yeah. It's going to make 5.5. It's growing again 10%. So another 50 cents you will add. So now another 50 cents will put this one at $6.05.
Yeah.
10% growth. Now 2025, you're going to earn $6.65. 10% growth. When?
Yeah.
So you can see Dave here that it's not going to take you the 20 years to recover your money because there is a 10% growth. So if we go here, keep going, you may recover your $100 by, let's say, your 11 or 12 or 13.
Yeah.
Other than the year 20. Because year 20, we assume that there was no growth. So that was a straightforward calculation. Everything is $5. So there is nothing you can do. It's going to be $5. So many times what happened, the PE ratio, when you see 40 times PE ratio, there is a possibility the company has a high growth. And that's why people are paying high PE ratio, because even though they're paying because 40 times multiple, they would recover their money within 15 years. And you will see there are companies that have the 15 PE, probably growing at 6% or 7%, and you can recover your money in 10 or 11 years. So the PE is very subjective, but you have to keep in mind that you have to be flexible with the PE. Like Warren Buffett has a one thing that what he does that he doesn't like to pay over 15 times. So if you see any of his investment, most time the maximum he will pay 20 times, or and that also in the case where he buy out the company. Otherwise, if you see his latest investment, you go and look his portfolio. And that is the one of the reason he's not invested in technology, because in the technology, he has to pay high PE, which he doesn't like. And he's a value investor and he thinks differently. When he bought Apple, even at that time, Apple was trading at 15 times multiple. Now Apple is trading at 25 times. So the PE, now what you have to remember is that you have to remember the 15 PE is ideal, okay? It is ideal in the sense, even the company has a 3% growth. If you pay 15 times, it's called good year. You're not getting exceptionally cheap, but it's a moderate, okay? Now, what's going to happen with the PE, that why the 15 times? Why market has decided to do 15 times? So the reason why they decided this, that S&P 500 has produced for last 45 years on average 6.5% plus dividend, probably 1.5%. Total somewhere around 8%. Okay, so the 6.5% means it's earning $100. If you invest $100, you earn $6.50, right? So we can find the PE here. Okay, the PE going to be $6.50. 100 divided by $6.50. So see that this is the one reason why most financial experts says 15 PE is ideal. Now we looked into this. So when there is a PE is 15 PE, okay, when the PE is 15, if you want to find it out the interest rate, okay, for that particular year, what you will do is divide 100 divided by 15. So that would be what, 6.6%. Okay. Now let's say you are paying 40 times PE. If you want to do this one here, let's do it here. So when you divide it with 100, like when you take 100 and divide it by its PE, you will get the rate of return. So in this case, the rate of return would be, or earning would be 100 divided by 50, and the rate of return would be around 6.66%. Okay. Now, let's say you're going for 25 times P, and your return going to be 4%. Let's say you go for 40 times P, your return now decrease drastically because 2.5%. Okay. You go for 50 P, your return would be
Two.
2%. Okay. So see here how the PE ratio. Now this return is 6.6% is for the first year. Now in the second year, if the company is going with the 10%, you will get the different earning per share. But my point is here that as you go higher and higher on PE, and if the company has not growing or company doesn't have that high growth, then it takes a lot of time to recover your money. Now in the past decade or so, 15 years, the reason why all stocks get inflated, because what happened that every time the stock investment either get compared with the real estate investment, how much return you are getting, or how much return are you getting using the risk-free treasury bill, mainly risk-free treasury bill. Now, if you see for the last 15 years, see the last 15 years, if you just see these, okay, I can see more. Okay, so the 10-year treasury bill was earning 2.48%. Okay, so when it's earning 2.48%, I could justify investing in the company that has a 30% growth and earning 2%. I can go up to 50 times PE. And that's what happened in the market in the last 15 years. Now, what will happen that if this 2.48% increase to 6%, then nobody will go for this high PE because they are getting, without any risk, they are getting 6%. So the stock market started to get compressed. Nobody want to pay high PE 50 times, 40 times, 25 times. They will say, we go, in this case scenario, we will probably pay 10 times PE because we are earning more that way. And so PE ratio has like a lot of effects from treasury interest rate and from the company's growth and in how, and if the company is making high return on equity, the PE is also going to go higher. So there are three factors that affect the PE. The first one is the growth. Okay. Second one is T-bill, government risk-free bond. Third one, return on equity. Okay, If you recall, remember the beginning of the session, I have shown you that I will pay 32 million for that company number one, but I would not pay 32 million for company B because the company A was producing high return on equity. So I went for the higher multiple. So these three things affects the PE ratio. So when you make investment, you just have to say all these three things because you cannot say, okay, this company is trading at 30 times PE, I'm not going to buy it. You have to look for all other things. So if we take example, right now, you will see here, NVIDIA, okay? Can you see how much PE ratio is that? Is 48 times.
Yeah.
And I have bought it. I have bought it. You know why? There were only couple of, like, even though it has a high PE, when you make your portfolio, you need all kind of companies. So this is the growth aggressive company. You also need defensive company, which are trading around 15 times or 20 times PE. Some companies, market sometimes make a mistake. And so there is another company. I also have this one in my portfolio. These two companies are completely different. See how much I'm paying for PE ratio. Only 3 times.
Yeah.
Because what I notice here, the market is mistaking. Because it's earning $2.25. And it's not in the like high-tech kind of company. Tupperware is, you know, like the containers, plastic containers for lunch and stuff. So according to me, if I give 15 times PE to this should be traded around $30. And this is like very quick thing I can think about. Like I go to this first thing here, PE ratio. I just want to see that how accurate this PE ratio and earning per share. And that you can find it out is go to the statistic. Go for forward PE. See, the forward PE should be close to whatever trailing PE. Then when the forward P is go, let's say the forward P is 15. That means that this $2.48 on $2.25 earning was a one-time event. Because in the next year, they're only going to make probably 50 cents. And that's why the PE is now inflated because $7.16 divided by 0.14 times earning. So what I usually do is this the real earning per share company is going to make? So it is proving here, yes, because there is not that big difference between forward PE and trailing PE. Then I go for here. How much cash they have? Okay, they have $5.36. Their debt is little high. Okay, why it is high? Because his net income is 140, and I don't want to pay more than 5 times, as we discussed it previously. So 570 million I can pay. Okay, so there is a one exception I'm doing here. It's okay, I'm paying little bit. What risk I'm taking? It's the company has a high debt. Now, when I'm taking that risk, I know that the trailing P is 3 times. The company could easily. So what company has done is companies also selling their other businesses. The new CEO is there. He wants to turn around. So what he's doing that he's selling other businesses that are not directly affiliated with the main business. And what he sold something just now, Nutrimetrics. They have this business for 250 million. What he's going to do is going to pay the debt. So what I am thinking that, okay, it's not exact science, but I'm thinking within 3 years, this should trade around $30, which is 400% return, 300% return. Okay. So I have this kind of company also in my portfolio. I have like company like NVIDIA. The reason why I took NVIDIA, okay, why I am paying PE ratio 48, it's the NVIDIA's chips. And anytime if you want to find it out what company is doing, how company is doing, right? You don't know about all the companies. What I usually do, I go to the profile, I go to the investor, okay, and then I will look for the presentation. So they do investment presentation. Now, when I go here, okay, these give me idea what companies is doing. So total revenue of 46%. It's crazy. I mean, okay. So do I know like very detailed about NVIDIA? No. I'm using my common sense. What is my common sense is? Okay, NVIDIA, all multi-game, CPU, GPU use their chips. I have heard the presentation from his CEO. I'm thinking the NVIDIA in next 10-15 years going to make a lot more money at very high rate, at very high growth rate. Why? Because if you think the next 10 and 15 years, everything will be asked more and more chips. Because we are going into the auto industry, we need more chips now because everything is electric, getting electric there. We are making smart home, we need more chips. There is metaverse thing is going on. So I'm using my general common sense. I don't know in a detail, but I use my common sense. Okay, NVIDIA, okay, I can pay a little bit high. The reason is this, that there is no other company can do what NVIDIA is doing. And I'm using my guess. Now here also the risk is there. In Tupperware, you see there was a high debt. Here I'm paying high price, high multiple, 45 times. Okay, so there is always risk, but you have to. I know that NVIDIA would trade 10 years from now more than what it is trading right now because of the demand, because of the company is in the transition mode where everything is going to go for Internet of Things and stuff like that. So that's for that reason I pay for NVIDIA high price. Another thing what you can do is many times if you want to find it out. So let me show you how to value the company using. So usually here, if you make very quick decision, whatever the next 5-year interest, whatever the next 5-year growth, pay that equivalent amount of P. So in NVIDIA case, you see the next 5-year growth is 23%, around 23%, right? What P would you pay? Ideally. What I told you, remember? Whatever is next 5-year growth, that should be your P.
So would it be 22%?
22% or 23%? So
23%, yeah.
23 P. So P is 23. I can quickly look, just looking at here, I can say 23 times I can pay. It's trading at 47 times. Okay. I'm paying over twice.
Yeah.
Why? Because there is a one term called price to earning divided by growth. And usually, if it's 1, then it's good. And then if it's go below 1, it is getting better. So let's say in this case of NVIDIA, the growth is 23 times. And your P is also 23 times. So it's 1. Let's say growth is now 50 times, 50%. And the P is right now 25. As you go, sorry, so let me rephrase it. If it's go above 1, it's good. Depend on what you're putting on enumerator, and we are putting price to earning on enumerator and growth in the division. But if you do other way around, so if you put growth on the top and the P down, then the value below 1 should be good. So in this case, P ratio, PEG, what is it called? PEG. It's called price to earning divided by growth. Okay, so when I look into this stuff, I know immediately that I'm paying high price for NVIDIA. Now, so there is no one factor to decide the price of the company. The multi factors are come into the picture, and you will get that thing. As more and more stock you will look into it, you get more experience. You can decide in 5 minutes how much you want to pay, how much more you can take. Is it justified to pay this high PE? Now, for example, the Microsoft. Okay, for Microsoft, there is a PE of around 27, 28, which is high PE, little bit. Okay, I would probably not pay. I would probably not buy Microsoft right now.
Yeah.
What I would look for is around 20 times PE, because you have to understand that the Microsoft is 1.962 trillion. If you want to grow 2 trillion, you have a 2 trillion market cap. What is the growth of, let's say, their growth is next 5 years is 15%. So ideally, I should not pay more than 15.74 times, because whatever is next 5-year growth, that is my PE supposed to be. That is very quick thing you can do. Now, why are you paying more, 20, 22 times? Because I look here. No debt.
Yeah.
104 billion, 77 billion debt. So Okay, the another thing I look here, return on equity, look at that, 50%. So I can go above, okay, 20 above, because they are constantly producing high return on equity. So those figures just come into my mind at that point, and then I started to do, like I used to do a lot of calculation, but not anymore. I just go through these couple of numbers. I looked at them. Okay, what is the, okay, if I don't have, if I have a money and if I don't have anything to invest, I would probably invest in Microsoft. There is nothing wrong, but I would rather right now buy Google. Reason is Google is same thing. Okay, very good cash, 133 billion. That is only 28 billion. Okay, good. Return on equity is little less, 30%. That's okay, good. But the main thing is here. This is not showing the right one because I think they just got the split. But if I see here, they're going to make $5.50 this year. Okay. $20 times. You won't see Google at 20 times. I see Google most time 30 times. And you also get, you know, like you see the company, you will see the how they make money, and then you can impart the PE thing, and you can quickly make things like, okay, I don't want to pay more than this, because the reason why I am saying that next 5-year growth is 14%, 15%. Okay, that's fine. The growth is little less. But I compare this one because if you see the PE ratio, where is the PE ratio? The forward PE you are paying 20 times, right?
Yeah.
Okay, look here now. And why market is mistaking? Look, Coca-Cola, forward PE is 25 times. Okay.
Yeah.
We go down here. It doesn't have enough cash to cover its debt also. Google has a plan, 100 billion cash after subtracting all that. Okay, second thing. Third thing, let's see how much, what is the growth? 6%. Google has a 15% growth. Why market is paying for Google 20 times and paying where Google has more cash than debt, where Google has a growth of 15%, where Coca-Cola has a 6% growth? Market is making mistake here because they are punishing all technology stocks and they think that Google growth story is over. Even you consider that the Google growth story is over. Okay, why are you paying? Coca-Cola is not a growth company. Coca-Cola is a defensive consumer company now. It used to be growth company in 1980s, but not right now. Why you are paying 25 times for Coca-Cola and you are hesitating to pay 20 times, 19 times for Google only? So what I did is in last 2 years, I bought so much Google share. Because this doesn't make sense. And another thing, what you can do is look at the business in the sense how the business is making money. Okay, in that case scenario also, both are equal, or Google is better. Coca-Cola, I understand that they make 10 cent syrup and they are selling for $2. Okay, so there is a huge profit margin, and I understand that. Okay, that business is great and people are going to drink Coke. The second thing, their distribution network is amazing. So they can go to the India, Africa, everywhere they can. So that is the plus thing. That's good. But when I look for the Google, I will just give you one my example. I have my own business, which is called pharmacyexam.com. If you see search here, Naplex. Okay. Here my advertisement is not coming. It's in the second page. Okay, see this one, this is my company,
Yeah.
right? Okay. You know what? If I click on this link, how much I have to pay to Google? Just clicking this link.
Yeah. It says 150.
No. That is the title of my products I'm selling.
Yeah.
What I'm selling this is the keyword, right? Naplex, right? This is the exam for which I'm producing the tutorial, study tutorial. And I have all these competitors, Frontopass, Naplex Tutor. If you go in the first page, same. Let's see what other. You know what I pay? If I click on this,
Yeah.
here for this Naplex keyword, he has to pay $6 to Google. One click and $6 is gone. That doesn't guarantee that the person will come on your website and will buy. And
Yeah.
Google has a monopoly. So if you think Google and Coca-Cola, they both are making very easy money. Google search engine, nobody now able to beat it. It's too far now. And the same thing with Coca-Cola. Now for Coca-Cola, you have only 6% growth, and you are happily paying 25 times earning, 25 times PE, 25 times PE. But for Google, because it's in the technology, it doesn't have any growth story left. Market is, and everybody is selling Google, so we have to sell Google also. And that's what these professional investors do. That doesn't make sense, and we have to take advantage of that. Now, in the case of Google, I spent so much money for Google advertisement to dictate the business to me, and probably not other people know about this because they haven't used the Google advertisement. But I knew it, and I know that this is, I mean, Google, if you want to sell for 20 times PE, I would buy a lot. I would buy more. If I have money, I will keep buying it.
Yeah.
And the same thing, even Warren Buffett understands this. Okay, Warren Buffett says one time in 2012, okay, that Google, Warren Buffett owns the auto insurance Geico. And Warren Buffett says for the auto insurance keyword, when you do the auto insurance, there are so many competitors, right? It's State Farm, and then all these other different companies, Progressive and blah, 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 blah. And they have the Geico. Auto insurance keyword itself, when you click that, because it's in the high competitive business, you have to pay Google $11 to $13 per click. And that was in 2012. Just think about it, the power, the way it's earning money, Google. Just one click, no surety, no guarantee. They will put user to your website, but that doesn't mean that user going to buy your stuff.
Yeah.
So when market started to make those type of mistakes, you have to combine all these things when you try to evaluate the company. And you will get that idea once you know about the company and once you know how they make money. So, and there is other way also. Like, okay, sometimes what happens, like, okay, we will just look here. So right now the technology stock all are down, right? What
Yep.
you do is here, look, let me show you this. Other stuff, what you can do, this is the Coca-Cola example. So most stockbroker, right, like the broker you use for trading your stock, right?
Yeah.
They have the research report. Okay. What I do in that research report, it's easy because you go here. Okay. See here, it says PE ratio high
Yep.
for last 10 years and PE ratio low. Okay.
Yeah.
So let's say I want to find it out if I buy Coca-Cola right now, is it good or not good? Okay. So I take low PE average, 18.60, 21.10, 19.90, 20.90, 18.30, 18.10, 17.10, 16.60. Okay. How many years? 1, 2, 3, 4, 5, 6, 8, 9, 10. 10 years divided by 10. So you will get very quick idea. Okay, you know, if Coca-Cola comes around 17 times PE, I should look into it to buy it.
Yeah.
So, just get the 10-year average, right? And what the market is paying, not the high PE. What the market is paying in the low average, because we want to buy at bargain price. So this is very quick. Now there is another very good website. So what I do, if I have to buy, let's say, I want to buy applied material, okay? And applied material is the same thing. It's a cheap company, it's semiconductor, and believe me, in next 10 and 15 years are for these companies, like, because you need tips for every single thing in the world.
Yeah.
So applied material has a PE ratio of 13, right? Right now. Okay. If I look the chart, 5 year, they were about $167, right?
Yep.
Right now they are trading around 100. Okay. Now I like this company. I like the proposal. Okay. Thinking, this is look good. Let me go and look its cash value and the debt. Let's go here. Okay. So I like that also. Total cash is 4 million. Total debt is only 5.85 billion, which is very good. They are making 6.6 net income can pay off their debt in 1 year. Oh, that's very good. So let's go here. Oh, return on equity exceptional, 58%. Now market is making mistake here because they want to punish all the technology stock. They want to punish applied material also. Okay, so I like so far everything, but then I will say, how much should I pay? I have this subscription which you can once you start to do good amount of investment, this is worth it. It's like $15 per month. And I like this. I know this author and the person when they were creating this. So they created for us everything here, right?
Yeah.
If you see here, the applied material normal PE ratio is 22. And see, this is the earning line is going, okay? Earning line is going here, okay? This is the PE supposed to be. So it went there, see, it was there here, 20 times PE, $150. And then the market crashed because everybody wants to sell technology. Okay, good. It is trading now at 13 times. Okay, what I will do, I will look 22 times, 21 times PE, right? I will see what is their next year earning. Next year earning, they are making $8.49. Okay. Multiply by what is that normal PE? 21.6. The average, remember we did for the Coca-Cola manually? This gives you the average and everything. So you don't have to do that. Otherwise, you can also do manually the way I showed you from the Coca-Cola, right? That 10 PE you get together and bring out the average, right? So $8.49 multiplied by what is the normal 21.61. So according to me, applied material should be traded around $178. And it is trading right now at $100. Okay. So I will buy. So when you look, it's very like I can look into the company and I can figure it out quickly that do I want to buy or not. Let's say this is the LRCX, Lane Research Corporation. This is another company making semiconductor chips and everything. Okay. Yeah. And we look here, statistic. Most these companies have a decent statistic. You see that was not too much debt. 5 billion debt, cash is enough for that their net income can pay off the debt within 1 year. Perfect. Return on equity 80%. Wow. So this is it. Now I will go here. Trading at forward PE of 11, 12 times. Okay. I want to see what is their average PE. Let's see. This line is their average PE ratio line. 17 times. Okay, so I can pay 17 times, 17.25. What is the next year earning? $37.27. This should be traded around $655. What price it's trading? It's trading at $465. And another thing that what you want to do is that never think that stock is trading at 465 is expensive and the stock is trading at $5 is inexpensive. It's all how much they are earning. Here you are spending $465, but you will get $38 in return. And there will be a company where you pay the $5 and the company is not making any money. So then mostly like 99% of investors think, oh, $5 is cheap. We have to invest in $5. 465 is too big, too much. So first, yeah, that you have to remove from your mind that you cannot, just by looking at the number, just by looking at the price of the stock, you cannot say this is expensive and this is not expensive. So I think we almost had 1 hour. So what we will do is we will continue with these things next, but you get an idea, right? How to do the calculation, right?
Yeah.
And also what you can do is, see, most time I didn't able to do it in this session, but see what you can do is, let's say what is there on a current year, you can always calculate. So this is $31, their average estimates for year 2022, right?
Yep.
So they are growing at 12.39%. So remember we made a table for return on equity and we will add it, we will keep adding it. The same way you can make the table, okay? So right now it's 31.71. And the growing at what rate? 12.39. So the next year earnings should be $3, or supposed to be $39.28. Again, it's growing with 12%. We will add another 39, 12%. So we will add another $4. So it's going to grow $43. Like that way, you can figure it out. Let's say this is in year 2026, if it's making $60. Then you can also calculate the future value. What is the average P was for this? Was 21. Right, 21 was the average. Sorry, 17.25. What I will do is I multiply by this 60. The earning that is going to be happen after 1, 2, 3, 4, 5, 6, 7, 8 years, right? So what I did is I got the future value, $1,035. Then I will find it out the interest rate, which I can go to the compound future value calculator. Okay, now present value. What is the present value of $465.10? I want to see how much return I'm getting. There were 8 years. Yearly compounded and future value we calculated 1,035. Oh, I'm getting 11% return, 10.5% return. You can quickly find it out how much you're going to make for next 5 years or 8 years or 10 years.
Yeah.
If this percentage here is showing you 2.5%, then you don't go for it. Because the 2.5% you are getting with the treasury bill. Then why are you taking risk and investing in the stock? But we will do this, continue next week. Then the next week should be the last lesson, and we will also go through more example, because that would be the best way to find it out how to calculate the price quickly. But like, did you understand what we did today?
Yeah, I did.
Oh, that's good. Okay, okay. So with that, I'm stopping it here, and then we will do one more session the next week, and that should be all. That should cover everything.
Okay. Thank you.
All right, man.